The banking industry has been hit by a massive shock this week with the collapse of one of the biggest banks in the United States, Silicon Valley Bank, SVB. This has sent shockwaves across the entire business world and has left many people wondering what this means for them and their money. Let's take a closer look at what has happened and why this matters. Firstly, let's acknowledge that the collapse of a bank is a big deal. It's not something that happens often, and when it does, it can have far-reaching consequences for the economy and the wider financial system. SVB was at the heart of the tech industry, providing crucial funding and support to countless startups and entrepreneurs. It was a crucial player in the world of venture capital, and its collapse has sent shockwaves through Silicon Valley and beyond. So how did this happen? Why did SVB fail? Well, the truth is that banks are complex entities, and their failure is often the result of a multitude of factors. In this case, it appears that SVB was carrying too much risk and had made some poor investment decisions. This left it exposed when the economic climate turned sour, and it was unable to weather the storm. But what does this mean for you and me? Well, the collapse of a bank can have far-reaching consequences for ordinary people. After all, banks hold our money, and if they fail, we could lose everything. Thankfully, in most cases, this doesn't happen. Banks are heavily regulated, and there are systems in place to ensure that your deposits are safe. However, it's important to remember that the banking system relies on confidence. If people start to lose faith in the system, then things can quickly spiral out of control. So, what can we learn from this? Well, for starters, it's important to understand how banks work. When you deposit money in a bank, it doesn't just sit there in a vault. Instead, the bank uses your money to make investments and loans. This is how they make money, and it's what keeps the economy ticking over. However, this system is not foolproof. Banks can and do fail, and it's important to be aware of the risks. That's why it's important to spread your money around, rather than keeping it all in one place. You should also make sure that your bank is regulated and insured, and that you understand the risks involved. Ultimately, the collapse of SVB serves as a stark reminder of the fragility of the financial system. It's a reminder that we can never take anything for granted, and that we must always be vigilant and prepared for the worst. The collapse of SVB is a significant event, and one that has far-reaching implications for the economy and the financial system. However, it's important to remember that banks are heavily regulated and that your deposits are generally safe. By understanding the risks involved and being vigilant, we can all help to ensure that the financial system remains stable and secure. Have you ever thought about how safe your money is in the bank? You might have heard about the government's promise to protect your money in the event of a bank failure. But have you ever wondered how this works for businesses that have way more than $250,000 in their accounts? Let's take a look at Silicon Valley Bank, which is the go-to bank for tech startups in California. As you might expect, most of its customers have well over $250,000 in their accounts, which means a lot of that money is not insured by anyone. However, this is not a problem as long as the bank is doing well and making safe investments. But what happens when things go wrong? This is exactly what happened to Silicon Valley Bank when a perfect storm of events led to its collapse. It all started with the bank investing a lot of its customers' money in government bonds, which is a safe investment that most banks make. However, when they bought these bonds, interest rates were very low, which meant they didn't make much of a return on their investment. Then the government started raising interest rates to help stabilize the economy and control inflation. This meant that bonds bought at low rates, like those held by Silicon Valley Bank, were now worth much less if they had to be sold early. To make things worse, startups were struggling to raise money, which meant less money was coming in for the bank to operate with. This forced the bank to start pulling on its reserves and selling off some of its bonds to raise cash. All of this led to a massive loss of trust in the bank, as customers began to withdraw their money en masse. Silicon Valley Bank was unable to keep up with the withdrawals, and the bank collapsed. So what does this all mean for you? Well, it's important to understand that even seemingly safe investments can go wrong, and that no bank is immune to failure. However, this doesn't mean you should panic and start pulling your money out of the bank. Instead, it's important to do your research and choose a bank that has a good track record and is well regulated. In the end, Silicon Valley Bank's collapse was a cautionary tale about the dangers of relying too much on one type of investment, as well as the importance of having a diverse range of funding sources. So the next time you think about investing your money, remember to always do your due diligence and be prepared for the unexpected. Have you ever thought about how safe your money really is in the bank? We tend to take the security of our bank accounts for granted, but recent events have shown us that our money might not be as secure as we think. Take the case of Silicon Valley Bank SVB, for example. SVB is a major bank that serves many wealthy founders and startups in Central California. As soon as rumors began circulating that SVB was raising money and selling their bonds early, a stampede of wealthy clients began pulling out their money from the bank. Customers of SVB were seen lining up outside the bank, worried that their money might not be safe. After all, their accounts weren't insured by the government because they had too much money. The panic spread like wildfire, and before long, customers had pulled out a staggering $42 billion in just one day. This was a quarter of what the bank was worth. Word of the panic spread to Wall Street, and the bank's stock began to tank. In just 1 week, the bank's stock lost 80% of its value, making it even harder for the bank to raise new money to meet the demands of its customers. Things went from bad to worse when customers tried to withdraw all their money from the bank at the same time. SVB simply ran out of cash and couldn't meet the demand. This is when the government stepped in to take control of the bank's assets, but not before the bank executives paid themselves a bunch of bonuses. Friday of that week will go down in history as the second largest bank collapse in history, right behind the Washington Mutual meltdown in 2008. It's scary to think that our bank accounts are really just a list of IOUs plus 10% of our actual money. We don't want to think about it, but if we do, chaos can happen, and the system can collapse. That's why the government has always played an important role in making us feel safe about our bank accounts, even though they're really just a mental construct. In times of crisis, the government steps in to assure us that our money is safe and secure. For example, during the 2008 financial crisis, 500 banks failed, and taxpayers had to bail out the largest banks to prevent a catastrophic collapse. The Biden administration recently took extraordinary measures to guarantee that anyone who had accounts with the collapsed SVB would be able to get back all of their money, regardless of the amount. It's important to remember that the banking system is safe and secure, and that we don't need to panic and withdraw all our money at the first sign of trouble. Panic can spread like a contagion and cause a collapse of the entire system. Be sure to subscribe and enable notifications to view future information about global economics and business. Until next time.